Brian, knowing the rules that are based on age can give you a financial advantage when the time comes. So let's talk about important ages. First of all, birth through 23.
Well, every age is important, so we're having a little fun here relating it to income tax laws and so forth and other laws that are out there. So through 23, we call that the kiddie tax era. That means that your kids' investment income, so if you set up an account for them, they're earning money, they can be taxed at your highest marginal tax rate through age 23. So if your kid somehow came into money, maybe through inheritance or gifting or working and all of that, and is investing it, they can get a big tax bracket increase, unfortunately, through age 23.
So that's what we call the kiddie tax. What about age 18 through 21?
Yeah, 18 or 21 is often where a child's custodial account reverts to their control. So if they got an inheritance or a gift from grandpa or grandma when they were 8 years old and they put in a custodial account, for instance, in the state of Washington, when they turn 21, that's their money. A lot of states it's 18. Maybe you don't tell your kid that, but certainly that is the rule. It's their money, and they can choose to do with it what they want.
And next, let's jump up to age 50. Why is that important?
Yeah, if you're contributing to, say, a 401k plan or any retirement account, you have limitations on how much you can put away. Those limitations increase a fair amount at age 50.
And the next important age is age 55 or 59 and a half.
Yeah, at 55, you can start taking money from a qualified account, IRA account, monthly, say, over a period of time, and not pay the 10% premature distribution penalty. So if you take it properly, there's a chance that you could take it as early as 55. Now at age 59 and a half, a couple things happen. One is you can take money out of your IRA and there's no penalty for that. And for most 401k type plans, it's also the age where you can roll it over, even if you're still working there, but you can do an in-service distribution, transferring money from your 401k type account into your own IRA. That's not a taxable event. And then you can have more options generally investing your own money from your IRA than you can in Works 401k type plan.
The next age, Brian, is really important for a lot of folks. We look forward to it. Age 62. Why is that important?
Yeah, 62, you can be eligible for Social Security. You start getting Social Security checks at age 62. The problem with that is if you start taking it and you're still working, making more than about 20 grand a year, you got to start giving it back. So that may be, oh, I can take it, but I got to give it back. Oh, yeah. Well, maybe I'll wait until I retire or wait for other reasons on that. But you can take it as early as 62.
So 62 is the earliest that you can take Social Security. Many people do it, sometimes not the best decision. The next age I want to talk about is 66 through 67. Why is that important?
Yeah, for most people that's what they call full retirement age, meaning that you can start taking Social Security and you can also earn as much as you want. You can earn more than that, roughly $20,000, no problem, and not ever have to give any of it back. So some people might wait until full retirement age, if they're still working, before taking Social Security.
And between 66 and 67, it depends upon what year you were born. It could be 66 in 2 months, 4 months, 6 months, something like that. If you were to wait from age 62 till your full retirement age, approximately how much per year would you get in additional benefits to wait till full retirement age?
6.5% for the rest of your life for every year you wait to give up those 12 checks. Often the break even is about age 79, 80, right in there.
And again, the big benefit of waiting till full retirement age is the fact that you can make as much as you want in earned income. And I think that's a good thing to talk about, that when you're limited to the amount of income that you can make, we're talking about earned income. It's not money that you would receive from investments, right?
That's right. It's earned income. So that's an important consideration there.
Let's talk about age 70. Why is that important?
Yeah, age 70, if you haven't taken Social Security yet, take it then. It doesn't go up anymore. So between full retirement age and age 70, it's 8% a year increase because you gave up 12 checks. But age 70 is the latest that you would ever want to wait. If you did wait that long, then if you pass away and you're married, your spouse can get your Social Security if it's higher than their own. And so that's one of the considerations why some people do wait until age 70.
What are some of the reasons why someone would not want to wait until age 70 to take Social Security, being that that's when you get the most?
Because you need it. Yeah, that sounds great. I can have more for me, more for my spouse, for the rest of my life, but what am I supposed to eat? I retired, I'm 63. What am I supposed to live on? Well, you might want to take Social Security early then. So, it's a consideration. You got to look at your other assets, your cash flow, your lifestyle, also longevity. If you think you're going to live a long time, you might want to consider waiting. If you think, well, I'm not in that good a shape, I'm not going to live that long, or especially if you're single and your spouse isn't going to maybe need your higher Social Security, if it is, then you might take it earlier. So there is a lot of considerations there, but certainly the different ages have different rules assigned to them as different things can happen throughout your life. So just want to have a little fun throwing out some different ages and some of the things you might want to think about.
And finally, Brian, age 72, why is that important?
That's when you got to start your required minimum distributions. And so you got to start taking money from your left pocket, putting in your right pocket, your qualified IRA type accounts, putting into non-qualified accounts a certain amount prescribed by a table. There'll be a percentage. You add up all of your retirement account assets, multiply by that percentage, and that's the amount you got to take out. If you don't, you have a 50% penalty, but you got to take that money and be taxed on it after age 72.
Brian, thanks for telling us more about important ages.